right, my friends, you made it. You have a successful multi-jurisdictional business. You're making millions or hundreds of thousands of dollars in sales every year. And now the question is, where should you go? You already set up on the business side, but where should you live personally? That's today's topic. Let's dive right into it. Hello everyone, my name is Javier Correa and I'm a Research and Development Associate here at Nomad Capitalist, where we help 7- and 8-figure entrepreneurs go where they're treated best. Now, the important thing to note from Nomad Capitalist Service is that we always look at the tax-friendly quadrant. We help your business go where it's treated best by ensuring that you have access to the best business entities and corporate entities around the world, ensuring the highest degrees of privacy, asset protection, access to good banking, etc. But oftentimes we will see that people tend to be very focused on their business, and they tend to understand that their companies have to be high quality and have to be located and do business in places that are either tax-friendly or tax-free, but they often overlook where they should themselves be living. As I've stated in earlier videos, it is practically useless, to not say totally useless, to have a brilliant and beautiful offshore corporate structure and then just live in a high tax country with terrible tax rules. Now, granted, if you live in a high tax country, you may benefit from the offshore corporate structure in terms of privacy, to certain degrees in terms of asset protection, but in terms of taxation, which is like the big element here, you won't really find multiple benefits if you yourself don't set up shop personally in a tax-friendly or tax-free country. So with that in mind, drum roll please, let's talk about the best countries where you can live if you're running an offshore business. So let's dive right into it. Number one, obvious choice, any country that is simply pure zero tax. That's a no-brainer. We talked about in previous videos how the traditional offshore tax haven, those little Caribbean islands and South Pacific territories, are dying out. It's not really the way to go in the 21st century, but a handful of them still exist. And if you are really keen on that super traditional approach, Gordon Gekko type approach, then obviously you can do that in places like the Cayman Islands, like the Bahamas. If you live in one of those places, there is simply no income tax, no wealth tax, no capital gains tax. In Europe, I talk a lot about Sark, the medieval kingdom off the coast of Normandy, between Normandy and England, that is basically the last tax haven in Europe. We have a great video on that. You should check it out. So sure, if you go to Sark, if you go to the Cayman Islands, all of these places, you can basically enjoy your offshore corporate structure to the fullest extent because your place of residence simply has no taxation. There is the complete absence of taxation where you live. Now, in most cases, when I talk to clients, they are not too eager to live in some small Caribbean island. And no offense against the Bahamians, I love the Bahamas, great beaches. But, many people that come from abroad would say it's a holiday destination, but they don't view themselves maybe living in the Bahamas full time. Same thing with the Cayman Islands. And well, Sark, while I find it very entertaining, we have to acknowledge the fact that there are no cars on the island. People ride their horses around, basically only inhabited by 500 people. So I've had maybe 1 or 2 clients that really are, due to their personalities, very keen on going to Sark, but generally speaking, I don't know many people who are jumping on one foot to move to Sark. What does that leave us with? Tax-friendly countries. So tax-friendly countries can be divided into a broad subcategories, of countries. So number one, I would say you should look at the territorial tax countries. Now, we've made videos about multiple of these countries, your Panamas, your Uruguays, for example. These are countries where you can essentially live and you only have to worry about local taxation. Now, the trick here is, even if these countries only tax local source income, a lot of our clients mistakenly believe that because their customers are located outside of those countries, they're not liable for tax there. If you look at my previous videos, I always talk about understanding where your income is sourced. If you're an investor, that's easier because income is always sourced where the payment comes from. So basically dividends, interest, royalties. If you're being paid from the US, the source is the US, even if you live in Panama. However, if you're looking about active income, and you're talking about active income, then active income is sourced where the work is performed, meaning that if you're in Panama or Uruguay or any of these tax-friendly countries and you're performing the work from those countries, that's locally sourced income and therefore fully taxable. Now, there are a lot of nuances. Uruguay doesn't have exactly the same rules as Panama. Panama doesn't have exactly the same rules as the Dominican Republic. So if you want to dive deeper into one specific country, be sure to contact us at nomadcapitalist.com/apply and we can have a much more detailed detailed discussion. So who does the territorial country work for? It works for the person that either has their business being run by a professional management team. So some of you might be at that level. Maybe you are the major shareholder, but you hired a super great CEO that is running the day-to-day operations and you're just worried about collecting your dividends, right? That's option number one. Option number two, if you're very mobile, let's say you live in Panama, but you have no problem in flying out to whatever destination it is to do business, to sign contracts, to have board of directors meetings. In that case, a territorial tax country might also work. So if you're willing to do one of those two things, or if you're in one of those two scenarios, then a territorial tax country could combine beautifully with your offshore corporate structure. Another option here, and we're, let's say, increasing the degree of complexity, would be if you go to Europe to some kind of non-domiciled tax regime country. So we talk a lot about these countries in Europe. We are big fans of Ireland. We're big fans of Malta. We talk about Cyprus on this channel a lot. Unfortunately, I won't stop saying it. I'm really sad that the UK is leaving the non-dom club. But overall, these are countries that allow you, great opportunities if you're a foreigner relocating to these countries, especially, and you can take up residence in these countries, but if you keep your domicile, again, remember domicile, center of vital interest, whereas residence is where you're living physically at the moment, so the two concepts are different. Many people try to use them interchangeably, but legally, they're two different concepts. So if you're under the condition of being a resident but not domiciled tax resident of these countries, essentially any income that is earned, overseas is usually not taxed unless it is remitted to these countries. So again, you can live in a Dublin, you can live in a Malta, you can potentially live in one of these wonderful European countries. And once again, if your business is run by a professional management team outside of your country of residence, or if you're willing to travel every time you have to conclude active business, contracts, board of directors meetings, meeting clients, then you should be good in a non-dom country. Also, the good thing about non-dom countries is that usually these countries are located mostly in Europe, with the sole exception of maybe Barbados in the Caribbean. So in Europe, you'll have, access to a higher standard of living. One of the things that I like the most about Europe is potentially having your family in Europe and having your kids grow up surrounded by multiple languages, which I think is one of the most wonderful gifts you could ever give to a child, is opening them up to multiple cultures and multiple languages. And Europe is definitely the best place to achieve that goal. So if you're in this situation, then again, a non-domiciled tax regime country might be very beneficial to you. In addition to that, you could also look into a lump sum tax country. So here you have some of the other usual suspects you hear us talk about on this channel. You have the Switzerlands, you have the Italys, you have the Greeces. So all of these are places where you can essentially relocate to, and you know that, especially with regards to foreign income, in the case of Greece and Italy, you can pay a fixed per annum amount and you will not be bothered in terms of taxation with any other additional income. So especially if you're a very high earner, this can make sense. Keep in mind that Italy's per annum lump sum tax comes in at 200,000 euros. So, if you're just a high-paid freelancer earning $300,000 a year or 300,000 euros a year, sure, you're making good money, but a lump sum tax regime may not make sense for you. However, if you are a multi-millionaire investor, or if you run a pretty big business and you're making income north of the 10 million mark, then $200,000 lump sum to live on Lake Como in Italy, I think it's a pretty good deal. So once again, here, the issue is you have to make sure to avoid permanent establishment rules. So similar to what happens in territorial tax countries and in what happens in non-domicile tax countries, is you have to make sure that your business is not sucked into the tax net simply because you're performing active management of the business in your country of residence, or any other ties that might essentially suck your business into the net, like having an office, having a warehouse, or any other type of link to the country. Now, we've talked about all of these. You also have certain countries, a bit more rare, that have some special incentive for like expats. So for example, you have in this case countries like your Spain's, for example. They don't have a non-domicile tax regime, they don't have a lump sum tax regime, but they do have a special regime for expats, in the case of Spain known as the Beckham Law, and you can go there and you can essentially turn Spain, which is normally a very high tax, very aggressive country in terms of taxation, into a territorial tax country for about 6 years. So it can also work very well. The other consideration I would add to this is if you're running a global business, you might consider relocating to a country that allows you, even if it's tax friendly, to enjoy access to a good network of tax treaties. And this is where, for example, Spain might be at a disadvantage because if you use its tax incentive, then automatically you do not qualify to use its tax treaties. So here, maybe a non-dom country or certain lump sum countries might be more beneficial. So depending on where you have your investments, you might look for a specific country that has a tax treaty with that specific country. You know, it all depends on your particular circumstances, on your particular reality. But the important thing is you always have to find a way in which you live in a country that either lightly taxes, does not tax at all, or only taxes certain income in certain specific circumstances that allows you to legally avoid or defer taxation basically indefinitely. And there is one last group of countries which might be interesting to look at. And these are the countries that have worldwide taxation systems, but maybe lack one very important element, which is controlled foreign corporation rules. Now, there aren't that many of them, but there are a handful of them out there. One of them, for example, is Switzerland. So you might say, Javier, you're going to talk about Switzerland again. You just talked about Switzerland a couple of minutes ago. Yeah, but I talked about the lump sum tax regime. That has nothing to do with the fact that Switzerland doesn't have CFC rules. Even if you move to Switzerland and you don't qualify for the lump sum tax regime, you know, we have a full video on that. I actually talked about that where I said, listen, the Swiss lump sum tax regime, it's not the best. It gives a lot of, it provides for a lot of limitations that you have to follow in order to actually qualify for the tax. The main one being, for example, in my opinion, no gainful activity in Switzerland. You can't move to Zurich. If you fall in love with a Swiss national and you want to marry her or marry him, then, you know, you no longer qualify. If after 10 years of being a resident, you want to qualify for Swiss citizenship, you can't do that without losing the lump sum. So overall, not a fan. I have a huge video on that. Go check that one out. Switzerland is one of those rare examples where even if you are a tax resident under regular circumstances, you do not have controlled foreign corporation rules. And what does that mean? That means that provided that you avoid permanent establishment links in Switzerland, then essentially you can indefinitely retain earnings in your foreign company. So if your foreign company is structured in such a way that it is tax-free, you are able to retain earnings there and only pay tax in Switzerland when you pay yourself out a dividend, meaning that you can essentially turn a worldwide taxation country into something that is more or less similar to a non-dom regime in which you're only paying taxes on money that you're paying out to yourself. Now, it is not exactly the same. Under the non-dom regime, you have the remittance rules, worldwide taxation system, regardless of where the money is received, you're going to pay tax. But the important thing is you can control when you issue dividends to yourself. So for example, Switzerland is in that group. The Dominican Republic is in that group. Now, the Dominican Republic does have a semi-territorial system where some foreign income is taxed, some foreign income isn't taxed, but they don't have CFC rules. So similar to Switzerland, you can simply retain earnings indefinitely in foreign corporations. Countries like, for example, my native homeland of Venezuela, it has somewhat limited CFC rules. Really, they're called fiscal international transparency rules, but they only apply to certain types of income. So honestly, if you're running an active business and you're a tax resident of Venezuela, again, you can retain earnings in your foreign company, provided that you're avoiding permanent establishment, just as I described, and you can also control what taxes you pay in Venezuela and when you pay the tax. So there are multiple countries that have this type of arrangement and this type of legislation that allows you to move your pieces around. There are also some countries like, again, my favorite example, Switzerland, where certain specific types of income are explicitly excluded from taxation altogether. So depending on the type of offshore company and offshore business you're running, these countries might be beneficial. So for example, no capital gains in certain jurisdictions, no taxation of foreign rental income in certain cases. I know I've talked a lot about Europe, but for example, we still help people move to Dubai. Dubai isn't completely dead. On the corporate side, you do have a 9% corporate tax, which is really bothering most people. But if you run the certain specific kinds of businesses, then you can still benefit from zero tax. And on the personal side, it's still tax-free. This video was a bombshell of information, and this is good because what I want you to understand is that the world is open to you. The world has never been as open as it is right now. You have the freedom to go wherever you want to go to be treated best. Lump sum, worldwide with no CFC, territorial, country A, country B. The world is here for you to choose. So if you want to check out what options are available, if you want to have the world available to you right now, nomadcapitalist.com/apply. Subscribe to this YouTube channel, follow us on Instagram, and I'll see you in the next video.